Καλημέρα σε όλους, καλώς ήρθατε στο Economica. Good morning everybody, welcome back to Economica. Thanks a lot to all new subscribers, to all of you that watch my videos. If you are new around here, please subscribe and activate the bell, the notification, and you will know exactly when I'm uploading new content, which is very, very interesting. You will not find my content anywhere on the internet, on YouTube, anywhere, because it's very, very, it's truly technical content. And it's specific about financial assets, macroeconomics. I do a lot of research on my own. So I'm sharing with you my screen as usual, and you can see already you'll find something that you will not find anywhere else. So I have managed to put together a TD sequential indicator. So to understand at which point of the stock market cycle we will find ourselves. And as you can see, apart from jokes and things like that, today we will have a lot of material to cover, and we can start with a simple technical indicator which is called TD sequential, TD mark sequential, and it's very, very simple. It's something that you can do on your own. So basically, when you are on a chart, okay, let's see if we can do it this way. Right. Okay, we are looking at the S&P as well here. Okay, when we are on a chart, we start to count the bars. Okay, so starting from the previous 4 bar, one here, we start here. Let's say I'm making just explaining how it works. We have 4 bars, so starting from 4 bars before, we count, the indicator counts the following 9 bars, 9 closing bars, 1, 2, 3, 4, 5, 6, 7, and then it will have to count 8 and 9, and then it sums up to 13. Okay, then the indicator works out where it's going, the trend, if it's uptrend, downtrend, it's sideways or something like that, and then counts another 13 bars, and it gives you a signal, okay, whether the market is overextended or it's oversold. Okay, and basically for the closing price after the counting 13 bars, it wants to find if the closing price is above the closing price when the indicators started the countdown, and then if the closing price is above, then you receive a sell signal. If the closing price is below the closing price when the indicator starts to count from the starting candlestick or bar, then if the closing price at the end of the countdown is below, then you'll have a buy signal or similar. That's roughly the way it works, the TD sequential indicator. Okay, so on my own, I built this TD sequential indicator, and I can basically see, I can do some technical analysis, what many people like, but on a different level, on a different scale, because I want to understand perhaps not what is the short term, like the next hour or half an hour, next nanoseconds or things like that. I want to know what is the cycle in the market. Are we on a cyclical uptrend? Are we extended in these cyclical uptrends? For how long it has been going? Etc, etc, etc. It's more of a medium to long term horizon, or it can be even shorter term. So for example, we have the average cyclical period for the S&P 500. It's around 19 and a half days. So I know for sure that 19 and a half days, it's around 21 days, which is a whole month of business days. So we are in that range. And then basically, when you do this sort of analysis of stock market cycles, then you understand basically what is the beating pace of the market. So how long-term and medium-term and even short-term cycles, they work together, and what are the signals in the market. These are probably these are indicators or technical signals which are more appropriate for people who want long time or medium to long-term horizon investment advice. So they want to understand, okay, I have a bull expansion, that's called bull market, or a market expansion, and based on past data, I know that a market expansion can last between 2 to 3.5 years, so I can get invested now. And but it means it requires to know exactly where, at which point you are in the market, and if these are long-term investment horizon opportunities, or if we are in a shorter and shorter cyclical market, which is more and more volatile, and basically that requires a different portfolio adjustment. So perhaps the volatility, perhaps for sure, the volatility in the market is more subject to drawdowns and to volatility, like when there are portfolio rebalancing or at the end of the month. So we have a 19.5 days cycle period for in the S&P 500. So we know that perhaps every 20 days, 21 days, which is every month or something like that, you can have a rebalancing of portfolio or major financial institutions, and that's probably comes together with the highest volume of option contracts trade in the market, because there is portfolio rebalancing. So all the edges, all the portfolio edges, they tend to expire with high volumes on the same period, in the same Friday, on the same last Friday of the week, of the month probably. And so we have this kind of dynamics in markets. So based on my models, as I was telling you, we have the Excel, the Google sheet, and basically we can see here for each index that I put together in my study. You can see here the S&P 500 has a main cycle of cycle 1 12 days, cycle 2 17 days, cycle 3 2 months. So there is cyclicality in markets, and what we can observe is that some industrial sectors or some indices, they have the same frequency, the same cyclical frequency, and well, the amplitude, it's another thing. And for example, so you have synchronized indices or synchronized capital flows in the stock market, inflows and outflows. Let's think it as a wave. So we have waves of liquidity going in and out, washing in and out of the market, and that basically, it's like the sea, the movements of the sea, and then we have the moon that with the gravitational pull provides basically the tides, the waves, and we have this wave movement, and we have the cyclicality in the indices. So we have the S&P 500, the Dow, the NASDAQ, the composite, and the NASDAQ 100 is not a case. They have the same frequency, which is 17 days, and even the cycle 2 or cycle 3, they are very short. So it means that the cyclicality in certain type of stocks, which are tech stocks, which are growth related, so they are momentum stocks, and then they are very short as a amplitude of the wave of the stock market cycle. But you will tell me, okay, well, we are in a long secular bull market. Of course, we are in a long secular bull market, but in the trading data, we can see that, especially for in particular for the tech stocks, the frequency of the cyclicality in markets, it tends to be shorter and shorter, unless we basically we utilize a larger harmonic, and so we see the whole period of the longer horizon cyclicality in markets. And I will show you in a minute what I'm talking about. So you can see here with me basically the Fourier analysis of the reconstructed data. So it's a calculus method that we can utilize to basically transform the differential equation of any financial asset into a Fourier transform, which is made of sine and cosine. So it's a periodic function, and basically it's transformed in a signal function, in wavelets functions. Let's put it that way. I'm not. I know what I'm talking about. I know the formulas and stuff like that, but it's a bit hard to explain, and I believe it's hard for people who basically go and watch this and say, okay, what this had to do with that? So basically, if I look at market, I need the order flow. I don't need the cyclicality. Yes, of course, it's a different thing. And now I've lost my page. 1 second. Yes, so we have this short-term signal reconstructed from the price action, and we have also a chart that can make us understand what is the cyclicality, and according to how many harmonics we impose into the Fourier transform, we are able to identify different periods or different functions with a different amplitude and the phase angle and stuff like that. So the harmonic one is basically the most dominant market cycle, is what we would call the bull market cycle, or that basically happens after a stock market crash or a big recession, and then you have a long multi-decade expansion in the market. Now, according to my models, which are by no means, they are not perfect, but what comes out is that here, for example, the reconstructed Fourier transform of the Dow Jones shows me that the signal, or the Dow cycle, it's on a downward slope. I don't know why exactly. It's probably there is a divergence between the reconstructed Fourier transform and what is the price action, but it can probably anticipate that there can be a short-term trough in the market, or I don't know, it may be a longer period market signal that I am not capturing right now. But here, if we see here the individual Fourier components, we see here the pink line, how the harmonic one, the largest amplitude cycle, it has peaked sort of in 2020, and now we have a downward curve, and basically it works like a sine function or a cosine function, mostly as a cosine function. And so it goes from 1 to 0, and then to -1 to 0, and then to 1 to 0, and then -1 to 0, and then there is this constant cyclicality. And then according to the amplitude that we assign to the harmonic, we have larger or smaller waves, and the amplitude, it's able to capture the different time frame, the delta of the time frame that we can identify within the same price action. So we reconstruct the same price action for a discrete period of time. It can be 20, 30 years, 50 years, 100 years of data, and we reconstruct the periodic function, or the market signal. Let's call it the cyclicality of the market, because there are no certain signal in anything. But what we can appreciate is that all the curves, they're all pointing to the downside. So you say, okay, I'm going to expect the stock market crash. I'm not saying that. I'm saying that the cyclicality of the market, it's probably we are going from a bullish expansion towards a sort of short-term bearish contraction in the market. It can be cyclical, and it can be explained very, very simply by the fact that we are in Q4. We are going to have a pullback in January or February or March of in the Q1 on the next year. So probably the underlying trend into the market, it's already on a downward, the cyclicality in the market, it's already pointing towards the trough that is going to happen in Q1 2026. That's why the curve, it's turning, is going to the downside, because the reconstruction of the price action is definitely not what happens in the candlestick in the market. So it tends to give you a leading signal probably in what's to come. Okay, and we can identify longer cycles as we have here. I have another page here. Okay, so here we have what are the dominant periods for the indices that I put together, and it's a very good representation of encapsulation of the American the Wall Street market. So all the equities and all the stocks that there are. S&P 500, we have a collection of all the sectors of the S&P 500, industrial, financial, information technology, so all the different sectors of the S&P 500. The main NASDAQ, we have the Russell 2000, the 3000, which is the most representative of the whole stock market, even more than the S&P 500. Then we have the Russell 1000, the 2000 value, which is a very important index because it's a small cap value, And when we go into the field of FAMA French and portfolio allocation, we need to know if the market is more skewed towards growth and it's small minus large. So if we are more allocated towards or concentrated towards large cap, which are these large tech stocks, or there is portfolio rotation and we are more invested into small value stocks. So in that case, you want to be long the Russell 2000 value, you want to be selectively short some large cap tech stocks, which probably are very overbought. They have very large price to earning ratio, very large multiples. So like in these past few days, we saw Facebook, Meta AI, or some other large tech stocks, which saw very big sharp sell-off one day, taking money off off the table because the price was going to $600-700 a share. So basically you go and take profit from your position, and that typically happens always with the earnings calls. So that for some reason or another you have done, there are so many theories that it doesn't matter. So dominant period for the S&P 500, the longer period, is 9,025 days. The max amplitude is 3.4. Then max amplitude require a calculus formula and it's complicated. We don't go there. And what that does, it explains 0.72 of variance. Okay, which is very interesting because in this instance, let's see if I can do it now. Let's do, if we squirt the variance. Okay, we have the standard deviation and we know which is 0.85. Okay, so when we identify what is the dominant period, how many days you have a cyclical expansion or a bearish contraction in the stock market, it can last 9,000 days for the S&P 500. These are the main, and that explains 0.85 of standard deviation of all. Okay, and so these are important data. Every data it's important, but it's useful because it helps you to understand the broader, longer cycles in markets, and then basically it helps you to understand. You basically it opens your eyes because you are not constrained by the investor bias or these momentum stocks or these things. I'm losing the next 5 minutes of this, that, or the other, but it gives you a broader idea. Okay, I have 9,000 days of expansion, what I can expect next. It's not based on the next quarter earning calls, but it's on a longer period. Okay, the market is going down, up, I don't know, but can try to figure out what are what the market is gonna do next. It's very, very interesting. So the Dow is 8,500 days. The NASDAQ and Russell, they have 9,000 days. The Russell 3000, 8,996 days. Let's call it 9,000 days, more or less. So we see that these main index, they all have the same dominant period, the same frequency, the same amplitude. Not the same, but the dominant period, more or less, it's synchronized. We are around 9,000, 9,025 days, more or less. Okay, so there is synchronization in markets for certain indices, and we can see here when we go and check the S&P 500 for all sectors, we see that they all have the same dominant period, 8,178 days. So they are very synchronized, except for financial and industrial. So financial, they have a very shorter, not shorter, but if we go into the next column, we see dominant harmonic. They all have one. So the harmonic one is the largest amplitude cyclical period that we can have, with the largest the largest max amplitude. Then here S&P 500 financial, the dominant period, so what responds the most to what is the price action in the longer term is harmonic 2. So it's a smaller max amplitude, which is 1.36, and in fact it has a dominant period of 4,089 days. So that means that the S&P 500 financial, it has a shorter, it's half the bull expansion compared to the broader market, which can be the S&P 500. While instead the industrial, even it has a shorter the harmonic 4, and we have max amplitude which is 0.42, it's way smaller than 1, and we are at 2044 days. So that reflects also, in a sense, the cyclicality of the industry or the business. Okay, so the cyclicality of the financial industry, financial services industry, it's 4,000. What I have identified here is 4,089 days. So if in a year there are 365 days, you just we can compute it in two types of things. We can divide it by 252, which are the business days, and it's 16.2 years. Okay, of course, if we do for a full solar year, we shorten the period. Of course, we are on 11.2 years. So we are talking about long decades. Okay, if we take the S&P 500, 9,025 days, and we divide it by 252 days, which are the business days, it's 35.8 years of dominant period. So that's why the long term horizon, it's a very long term, it's a generation. Okay, so let's put it for a solar year. Of course, we've left to okay, 365, which is not perfect. 24 years, 0.7. Let's call it 24 years and 8 months. So still, it's very long time, sorry, generations. So the average dominant period for the financial services industry, we are between the 12 and the 16 years. Industrial, it's probably between the 8 and the 10 years. Sorry about that. I know I'm not showing you anything about stock market charts, and this is a different thing of different kind of approaching the thing, because we want to know how long the market goes in its cycle, in its cyclicality, and then we can basically have an idea which is not based on the short-term overbought, oversold, or anything, but a longer horizon, which is probably it's good for people who wants to have savings, who wants to say, okay, can I invest in the stock market now? Yes, no, I don't know. I'm not giving financial advice, but there are methods, and scientific methods, mathematical methods, to understand at which point in the cycle we are. So 244 days, it's 8.1, it's 8 years, 0.1 periodic, which are very, numbers are very funny. So if we take the NICE, I don't know, the New York Stock Exchange comp site, American comp site, or we take a flight to Nice, probably, or something like that. We see that they have different dominant period. That the NICE composite, it's 9,000 days, and it's exactly the same dominant period of the Russell 2000 or the NASDAQ 100 or the S&P 500 or the NASDAQ composite. So there is synchronization between these indices, but we can see also that the trading signal, not the trading signal, they are at a different point in their cyclicality. Although if they have the same dominant period, they are at a different point. And I can show you in a minute what my model tells me, where the market, what are the indices in this table which are overbought, oversold, which one are too old. It's it's a fancy thing. It's like a dashboard that tells you at a glance what's happening. Okay, just a few seconds and I will show you. And like oil and gold and silver, they all have a similar, or corn or soybeans, they have a very similar dominant period, which is around 3,160 days. Okay, so 3,000, let's take gold, which is very hot now, 3,158 days divided 252, it's 12 and a half years, or 3,158 divided 365. Let's give it a range. Okay, so it's between 8.6 years, 8 years, and 12 and a half years. So it's between 8 and 12 and a half years, the most dominant stock market cyclical period, where it's for gold or silver or oil or corn or soybeans. But we know that oil, it's being sold heavily, and gold is being bought heavily. So although they have the same dominant period, they point in completely different direction. So by no means they are synchronized, but they are at a different point in the cycle. Okay, so in that comes in what is the correlation between those two financial assets, and when this correlation change, so you can have a convergence or a divergence between these two things. So now let's try to find the I think it's on, okay, yes, we have it here. Very, very simple thing. Okay, so what our dashboard tells us. The NASDAQ 100 is in a bullish expansion. It's a strong upward. We have a high level of confidence that the trend is upward. And what it tells us is, okay, wait for clear signals. Okay, so if we go back and see, okay, here the TD sequential, we see here we have a red arrow down, a red, okay, red arrow down, which tells us, okay, the market is overextended. You start to have a sell signal, okay, from the TD sequential indicator. Now let's take, okay, NASDAQ composite. We have a big red signal here for a short-term sell signal because the market is overextended, okay. And the same is the NASDAQ 100. According to the TD sequential, it tells us, okay, probably according to the cycle peaks and troughs, we are at a peak now, at a cyclical peak, whether it can be a short-term cyclicality of 12, 17, 19 days. And so we are going, the market is going to, you'll see that the price action in the market will be going to sell what are very high stock prices, let's call it that, and then it reaches a trough, and then it starts to cyclically go up again. So this goes better with the time variable, so that if we not ignore the price, but if we set aside the price and we go for peaks and troughs, we can basically navigate the market in from a different angle. Okay, so our actionable trading strategy, that's how the file downloaded. So what our dashboard tells us, it's okay, you are in a bullish expansion for the NASDAQ 100. The action that you need to have is to hold whenever, if you are long the index, okay, perhaps just it's an example of how all this macro framework on financial assets, it gives you a broader perspective, so that you don't live with the minute by minute anxiety of the next stupid things coming up. Okay, and it identifies support and resistance levels, which are proper technical indicators. It's stuff that I really don't love. I don't like support and resistance, because those for me are point of non-derivation. You cannot find the second derivative, and then the thing goes AY. So so we have support 25,756, resistance 25,160. That's for the NASDAQ 100. Now let's take the S&P 500. Okay, the S&P 500 is here, and it tells us, okay, it's a bearish contraction, but the direction it's upward. That's why that is very, very useful, because it tells you, okay, the market is going up, but the whole index is in a bearish contraction. So if you see a sell-off, it's expected. You can reasonably expect it. It does not come out of any unknown parameter or any exogenous things. It's the cyclicality of the market, it's the period. Okay, so you know that you're gonna have a pullback for a couple of weeks before the Christmas rally. But the Christmas rally is a very short-lived period, because you know that it goes into Q1. You know, every year you do the same. You know that in Q1, everybody is selling, is taking the money off, because then you go into the tax year, and after all this volatility, you start to allocate after the volatility, and then you have a trough, you have a starting point, okay? Then you start to go up, but you go up basically from March, April down to October, November. Then it comes Halloween, it's the end of the year, so because we don't have any more light, and comes the darker period, and so basically you start to get rid of all these very expensive stocks, and you come back in spring next year. Okay, so it's very cyclical. It always goes with nature. We don't pay attention to this stuff because we are submerged by data, but magically, because of Halloween, the data tells us what we do as human beings, how we behave, probably according to the cycle of time, the cycle of nature. Okay, because we have there is these things which is very, very fancy. It's very everybody knows that the Greeks, they had two words for at least two words for this for defining time. They had kuklos, or they had chronos. Okay, so which is time. They had kuklos, or a cycle. Okay, because they saw that life had a cycle which was going together with the seasons. Okay, the spring, autumn, spring, summer, autumn, winter, and all the repetition of all these things. And then they had another third word, which is kairos. So the Greeks, they had a special word. So you have chronos, which is time, but you have kuklos, or cycle, which is the cyclicality of nature, of the cyclicality of the season of lives. And you have another word, which is kairos. And kairos is it's the equivalent of a carpe diem. It's the not exact, it's the perfect time to catch the occasion. It's the opportunity. It's the opportunity time. That's the kairos. It's the proper time to do that thing. Okay, it's the time when the train is no, not the train. Okay, it's the carpe diem. That's the proper time to get the opportunity. That's the kairos. Okay, and now we live according to ancient Greeks, probably, because now past Halloween, okay, we start to have some Celtic flavor to that. Past Halloween, we enter into the darker period of the year. Okay, and so it's scary. Whatever it's scary and it's unknown to us, we want to defend ourselves, so we take distance from that. And so what we do, probably, if in a fancy way, we sell stuff that we don't know what's gonna happen. So we sell stocks. I'm just, it's very round with words. But the cyclicality market, it reflects actually what people do. Okay, so S&P 500, we are in a bearish contraction, and I showed you. If we see, that's the S&P 500, okay. If we take the smaller sine function, we see that the smaller harmonic, the curve, it's pointing to the downside. So although the market, we see it very clearly here, although the pink line is going up, for the cyclicality, we are in a bearish contraction. So after the bearish contraction, I would imagine that the little baby bear is gonna pop up. Okay, so the direction is upward, the confidence is medium, and it says, okay, hold, and wait for a clearer signal. We have support 68.21, resistance 68.59. Now let's go back here. Okay, so we have 68.59, which is here. Okay, I will not take these things for very holy grail precise stuff. And what was that? Okay, support 68.21. So it's very, very narrow range. 68.21. 21 is probably here somewhere. Okay, I don't know for which reason it identifies this very narrow range. Okay, 68. I should change it by typing the input. 68.21. Okay, we have it. Okay, more or less, we are there. Okay, so according to my dashboard, that's small, not that small. The S&P 500 is in a bearish contraction, and the two key levels that identifies, which are not perfect, but it's this one, 68.21, 68.59, and we see that basically we have some sort of price action by the 1 hour bar chart, that you have some uncertainty or a sideways trading. It goes up and down in a narrow range, more or less, and basically they are trying to decide, are we going more on the expansion, or we are following through with a bearish contraction. And we basically come up with the little baby bear, okay, Winnie the Pooh or something like that. And so what do we have here is that, okay, we start to have the dashboard, it starts to tell us, okay, wait a minute, but although the market is going up, it gives you also the RSI 68.57. Let's see what is here. Oh, it's 40. Oh, no, that's a different time frame. Sorry, it should be daily. It pops up daily, or yeah. Okay, so daily. Okay, the RSI here is really lower, 61.46. So it calculates also differently the RSI, because it has less data than TradingView, of course. So we see here the latest price action, we have peaked at just very shy of 6,700. Okay, this very important level in the market. or 7,000 probably, or 6,700, sorry, I misspelled, 7,000, I'm sorry. So that's why this indicator or this method of understanding what is the cyclicality tells us, okay, market's going up, we are in a bearish contraction, which is actually very, very true. If we look at the chart, we see that we have a little tiny itchy glitchy itchy bitchy moving down, selling off, because we hit the 69.20 wall, and we go probably 100 points down from 69.20 to 68.20. And so the market rejects, investors or the intraday traders reject that level. It's very, very expensive. There is no buy. There are no buyers above those levels, or probably those buyers, they are very, very, they are weak. And the sellers in the market, they have a stronger hand. Okay, but nevertheless, we know that the S&P 500 trend is an upward trend. Okay, so it describes, it gives you very important information. We are precise. Okay, the trend is upward, but you have a bearish contraction. So, but it tells you to hold, probably wait for a clearer signal. If you are a technician, say, okay, if it breaks some level, probably if it breaks below that level, probably it's gonna sell more. But I will not bet on that. It probably goes on this level and it jumps back up again, because it's a support level. So I will not play the market that way with this support and resistance, because they are very misleading. But so we have our dashboard. Okay, so what do we have here? S&P 500 consumer discretionary. It tells us it's in a bullish expansion, strong upwards. The confidence of the trade, the signal, it's high. It tells us it's a strong buy. The cycle is turning strongly upward, okay, and it follows eventually also the RSI signal. So these are more technical things. Consumer discretionary, S&P. Can I find it, or it's okay? We found it. Okay, I don't know. Let's see here. Is that consumer discretionary? Okay, current price is 148. So they don't really correlate. Okay, so it's probably S&P 500 consumer discretionary. Now I'm a bit unprepared to this, but anyway, I don't think it's the same index. I cannot find it on the hoof right now. Just wait for me 1 second. Consumer discretionary. That means I have not prepared anything in advance. Consumer discretionary. S&P consumer discretionary. Let's try XLY. Okay, they don't seem to me on a at the bottom of any cycle, so I don't know from where it comes from, this thing. Just 1 second. Okay, so I'm crisscrossing on Yahoo Finance, but I found it exactly. So it's consumer staple. Okay, so that's the precise index which refers our table. And consumer staple, let's pull it up. Okay, it tells us it's on a strong buy position. Max. Okay, so it's quite elevated. Okay, but that's what it says. Okay, so 1 year. Okay, it seems that it has peaked a little bit. So we can see here that also the cyclicality is not really. It can be also for a short period, like 12 days or a few months. And what it tells us is basically that we are on a bullish expansion, and our dashboard tells us it's a strong buy. The cycle is turning strongly upwards. Okay, and we can presume, just looking at the chart, that it captured a few peaks here and here and here, and it's telling us, okay, now we are at the bottom of the range, let's put it that way, and it's a strong buy signal. So if you want to navigate the market, you can also use this kind of trading signals, and you prepare very well in advance, and basically you can say, okay, I can probably try and take some money off the S&P 500, and I want to invest more. If you go for indices, or you can find stocks which are in the consumer staples, which is not consumer discretionary. That's why I couldn't find it. The consumer staple sector, and we have a strong buy signal for consumer staples. So why? It's very, very in line for consumer staples. They are things that we buy a lot for the period or a festivity season. So the market anticipates what is the past cyclicality, what has been the past cyclicality in stock market indices, which reflect the in a sense, the economic activity captured by the stocks that are listed, the companies that are listed into the indices or the industrial sectors. It reflects the seasonality of the economy. No, we have a winter period when we buy more food or clothes, we buy more consumer staple items, and that you have a strong consumer push for, I don't know, Thanksgiving or Christmas or New Year's Eve, and all that kind of stuff, which is a global, also on a global scale, or even it's more or less it's a global trend. So, for example, you can take some chips of what are tech stocks or some sector which are very overheated, very pricey, and then you can go for some consumer staples, some comfort food or things like that. Now, what we have a bearish signal, oil service sector, sell now, and the urgency is immediate. It's really overbought. So this dashboard is is based pretty much also on technical indicators, and so if you manage to see this Philly oil service sector, you want to sell the index that tracks the companies which are in the oil services sector, okay, which is not only Chevron or Shell or BP or whatever are the large oil companies, but also those that are in the oil services sector. It can be ConocoPhillips, those that are warehouses and they store crude oil and then they resell it in the market, they work like that, or those that services the oil pipelines and things like that. That sector, that industrial sector in the market or services sector, it's overbought and you should sell it, okay? That's what the dashboard tells me. Another interesting thing for the day traders is gold. So we have a bearish expansion and a strong downward trend. Want to make it larger? I think you should be able to read it. Yeah, strong downward trend. The confidence of the signal is very high, and the action is sell short, and the urgency is high. What it tells us is the cycle is turning strongly downward. And you have support 39.85, resistance 4,007 bucks, and even comes up with some targets. What is the stop loss or the target? The first target 37.96, the second target 35.96. So it's calling for a very nice pullback in gold prices, and I will not discount it. I'm sure that this dashboard, it's it's accurate. It can give you some very good signals. And what also comes up is that the Canadian stock market, it's very overbought. It's in a sort of, not on a bubble, but the TSX composite, which is the main equity index benchmark for the Canadian market, is at 30,260 points, and it's actually in a bearish expansion, and predicted direction, it's a strong downward trend, the confidence is very high, sell short, cycle is turning strongly downwards, and it has these very large targets, which is 28,000, 27,000, so these are very large moves, and it describes what can be a potential stock market correction. So all in all, not what we can take away or what we can do with this, that, and the other. The info that we can gather from a similar dashboard that I want to stress again is it's based on technical indicators which are extrapolated from a Fourier transform. It's not technical indicators that you find in the market. It works with the cyclicality, and it's very interesting because it gives you what are the different cyclical timings in the market, if you are in a bullish expansion, bearish contraction, and what can be the predicted probable direction of the trend. Okay, so here, okay, bearish contraction, okay, that's the S&P 500. For most of all the indices, what comes up, it's okay, you have to wait for a clearer signal. There are very few which are jumps out as a clear market signal in terms of the cyclicality of the asset class. And also there's for soybeans, it's in a bearish contraction, you need to sell it immediately also because it's overbought, and it comes up with some target prices for the repricing of the soybeans in the commodities market. So what is very interesting, what is the info that I can give you now, is that gold probably is going to see there's going to be in the gold market, there's going to be a bearish downward trend. Also, it's important to be careful with the Canadian stock market, which seems to be pretty much overbought, and there can be an important pullback if we go towards the 28,000 or 27,000. We are talking about a 10% pullback, okay, from 30,000 to 27,000. We are 10% down, to 8 to 10% down, which is pretty much normal. It's the ordinary. We have an 8-10% repricing of the market, which goes with the cyclicality. So we reach the trough of the cycle, and then we start to buy again, and we have another expansion. Okay, so that's how it works. And then tendentially, the market goes up and up and up because it needs to have some trough somewhere, which you can call a support level, and then it goes up again until it pops in a huge bubble. So what it's interesting for me, just for a little minute now, it's gold. Let's try to add a chart of gold just to see how actionable can be the, okay, let's take the gold future because that's how the price is derived. Gold futures, GC, all right, okay. So, yes, we have a huge blow up here. It was in the September, I believe. Now we have, I don't know, this September or October. That's all these things. Okay, October was a huge blow up. We have all this tail of the candle, lots of probably failed auctions or something like that. And now we are starting the new month, the last 2 months of the solar year or the calendar year. Although our calendar ends with the Halloween and then the new year, the darker period starts, and then we come back to life in spring. And okay, so what it tells us is, okay, be very careful because it took the last closing price, which was 39.96, which is a little bit below where we are today. Okay, 39.96, it's pretty much here. Okay, so we are probably in line with the market, more or less, not very much in line. I want to see what is the level. Let's put the inputs. Oh boy, oh boy, oh boy, oh boy. Okay, 39.96 is here. It's undistinguishable from the weekly chart. Okay, let's zoom in. Okay, because I think we can do a zoom in, zoom call. Okay, so our dashboard tells us, okay, we are in a bearish expansion. So this retracement that we have after the huge blow up in October is not a small nothing burger retracement, but you probably can place yourself short. You want to sell, you can short gold futures, okay, which is a bit more expensive than shorting gold cash, okay, because it identifies that the cyclicality in the market, it's a bearish expansion. So this downtrend is going to expand probably, and oh dear, sorry. And we have cycle is turning slowly, strongly downward. Okay, so we have a resistance point here, which is $4,007. So we are above resistance here, and it tells us, okay, you want to stop the trade at 41.96. So very approximate here. Okay, at this level. Okay, let's put it 40. Okay, you want to stop here. Okay, let's see how this would short position. Okay, start here. So what the dashboard is telling us, it's to place this kind of bet. The first target is 37.96, so 3,800. Okay, 37.98.96. It's more or less a 4.95% downward. Then there is another target which is 3,600 or 35.96. Okay, which is very, very fancy. 35. Do I read it properly? 35.96. Yeah, 96.85. Even the cents. We're so precise. Okay, here we are. Okay, so what it's telling us, our dashboard, is that we are here, and say probably be careful. Okay, that the pullback that we have seen in the past weeks or in the past days and in the past week or whatever is the period of time is not a short time pullback, but is gonna follow up with a bearish expansion in the trend, and probably gold prices will discount further their value from now. So gold futures should be around $3,600, okay, around here, $3,800, $3,600. So what the cyclicality in the market tells us that the cyclicality of gold future prices, it's going downward. So I will not happily be long the market if I have a probable cyclical trading signal which tells me, okay, the pullback is gonna follow with a bearish expansion. So gold futures, they're probably gonna be traded lower because prices are too high. Okay, and for all the other sort of reasons, probably there are investment funds who want to go to cash, they need cash, and they will liquidate gold. They will liquidate gold, and that's what they will do. Or it's just a pure short bet on gold futures, and that's speculation, that's market speculation. Or we want to find proper supply and demand with gold, and then we see, okay, for 4,000 or more than 4,000 is very overpriced. There are so many reasons which we can imply to that. But I'm not in the business of doing that. So, and then, okay, the Dow Jones Volatility Index is in a bearish expansion, okay, short volatility. Okay, that's pretty, that's a almost routine trade that you can have in markets all the time. So, that's a little flavor of the material, the signal that I have and the study that I put together on the American stock market, all the indices. And yes, you can basically use a TD sequential, which works with the cyclicality in markets, and you can work with the RSI or the MACD. If you are a technician, okay, I think that it would be very, very useful if you use together this combination of two things, which is identify the cyclicality in the market, the long-term cyclicality, knowing the seasonality of the indices, and also adding some technical indicators that can give you the more confidence in what is the probable direction of a trade, if ever you want to speculate in market. But a good instrument to do that, as I said, it's the TD sequential. There are so many other indicators that can be built, so that I have so many dashboards and things. I really don't know from where to start, but I want to just take the other indicators that we can have. Okay, you can also try to backtest trading strategy using a TD sequential indicators, or the cyclicality in the market, and you can also, by reconstructing the market cyclicality, you can try to see if here, for example, reconstructing the cyclicality in the market, you can try to see what is the trading signal that you potentially can get from transforming the price action into a stock market cycle in a bullish and bearish phase, okay, and then the indicator translates and gives you the green or the red arrow if it's going up or down. And it can be fancy and interesting, nevertheless. And I want to find some other stuff that I put together. So as I was saying, we can add more some sort of what are institutional, like hedge fund indicators, and which are basically available anywhere. A useful thing to have is to see the money flow if we are in an accumulation or in a distribution period, and that goes well together with the cyclicality in the market. So if you have a dashboard that tells you, okay, you are in a bearish contraction, and wait for another signal, then you have a TD sequential which tells you, okay, you are overbought, and then there can be a sell signal in the market. You have a short-term that's gold, sorry. You have a short-term pullback. Let's say if we consider the S&P 500, that's a chart here. Okay, let's do it for the NASDAQ. Let's wait the page it loads. Okay, so the S&P 500. Okay, so let's see the signal for the institutional chart with the institutional trading indicators for the NASDAQ 100. So you have a long period of accumulation, and the cyclicality in the market tells you you are in a bullish expansion, strong upward high, and hold. Okay, wait for a clearer signal. Okay, then you start to see that from accumulation, probably you start to have a distribution period, probably, or eventually. So you can see that there is a strong uptrend, bullish expansion. You want to have other trading signals, and you start to search for technical indicators, and you want to know, for example, if the index or the market is in accumulation or in distribution. So you want to see the money flow, or you can gather another institutional technical indicator, which is the Arst exponent. And in this case, we see that the Arst exponent, it's this yellow line, it's below 0.2. What that means is that basically, even though the market is going up, the price action would warrant a mean reversion or mean reverting threshold. You see here that the red line is there, so whenever the Arst exponent indicator is below the red line, you can expect some market pullback or a convergence to the mean, to the average value. Let's put it that way. So you can gather more info on what is what actually it's happening beyond the price action of any indices or any stock that you are following. Then you can see what is the market choppiness index. So you can see if you are on a trending market, you have more volatility, so there is more let's call it choppiness in the price action. What are the volumes or the power of the bullish or the bearish volumes in the thing. So nevertheless, the NASDAQ 100, it's a long-term uptrend, but we can gather signals and say, okay, we can expect a mean reversion, we can expect a distribution phase, we can see probably the market from technical perspective. The market is the NASDAQ, it's a bit overbought, it's overextended. The stock prices of the tech stock prices, they are very, very expensive, they have very, very high multiples. So you can expect the market, that the cyclicality will give you an 8 or a 10% pullback, and you have a trough in the market, in the short-term market cycle, in a span of 12, 19 days, and then you start again the long bullish expansion. So there are many things that can be utilized beyond what are the simple moving average or the RSI. Oh, the RSI is useful. That's for what concerns the technical indicators when we are looking at a stock market chart. So of course, you have to build indicators. You have to know what you are looking for, what you want to know, or things like that. And especially for day traders, what is very, very important is order flows, order books, the depth of the market, volume profiles. So the candlestick bar, I would rather say, it's not the last thing that you need to have, but is the least useful in providing information about what actually is going on into the stock market. Because you see the price action, but it's not very, very clear what it's moving the price, why the price is moving that way. There are very strong short-term things which are momentum investing, which are based on the news cycle, the latest announcement, the latest earnings call. So they are very short-lived, and in that respect, the stock market structure itself, it has changed a lot with high-frequency trading, with algorithmic trading, and with daily expiration options. And now I have to be a bit more boring than what I've been until now. So subscribe, because it's very, very important what I'm about to tell you. If you are not aware of these things, subscribe to the channel, follow me, activate the bell so that you are notified when I'm uploading some content. So the market structure, it's changed a lot. So we know it's been a few years that we know, like, there are giants like Citadel, which are firms which do high frequency trading, and some other small prop firms which are market makers and provide also liquidity to the market. And there is this other very fancy stuff, which is the 0-day trading expiration options. So we have this basically intraday expiring options. And so that changed a lot the market structure because you can create a large, very fast, rapid volume of transaction pushing up the price, but in substance, underneath that price that inflates, there is not much, I don't know how can I explain myself. It's basically, not basically, the fast frequency of transaction in a stock or in an index future, and also combined with the daily option trading, those transactions, they are constructed to exploit what is a market arbitrage. So by definition, the stock market should not provide any free lunch or arbitrage, price arbitrage, but in the sense that I have a riskless profit that I can make by executing a certain type of transaction. But nowadays I can buy Amazon stock on the Paris Stock Exchange, and I can sell it for a fractional higher price on the Frankfurt Stock Exchange or on the NASDAQ Stock Exchange, in the New York Stock Exchange or Chicago, whatever, for a fractional higher price, and I make a profit, which is riskless, because I have identified a mispricing of the same financial asset. So I buy at a lower price and I sell it in a nanosecond at a fractionally higher price. And this technology, this high frequency speed, we are talking about 10 gigabits, 100 gigabits, I don't know, very speed light or something like that. It alters the market structure, because the stock market, the efficiency theory hypothesis of the stock market, it tells us that the strong form of the market, or the semi-strong form of the market, is whenever all the information are public and all the information are available, and technical indicators or fundamental analysis of balance sheet does not provide you any inside information or advantage. Basically the market is efficient because there are no free lunch to take. There is no possibility that you can have a riskless profit. But high frequency trading and the intraday option market, they have profoundly altered, changed the structure of the stock market, especially the intraday stock market. So they create this very split-second, nanosecond, microsecond arbitrage opportunity in prices. But to do that, or for example, if we take the option side of the thing, we have the delta and the gamma, which are the first and the second derivative of how the option premium changes, of the value of the delta changes with the underlying the stock price. Okay, so if I am long a stock with a 0-day option, 0-day expiry option, so I have a call for a certain stock at a certain price. What happens is that by the volume, the amount of 0-day option that are traded on that stock, you know that each option contract, it has a leverage of 100 shares. Okay, so the cumulative delta that shows me that the market is long that stock, and the gamma basically push other investors or pull other investors into go long that stock. And even what happens is that even market makers, because of delta hedging, if they write a call option, they have to buy the stock to hedge the call of the option, so the upside, okay, or what is the famous gamma squeeze, okay. And so what happens is that the market maker has to hedge his books, and it has to buy the stock on the other side to delta hedge, to be delta neutral, delta hedge the retail client or the other firm which has, I don't know, 100 calls on a long whatever, or short Meta or short Netflix. Okay, if I buy 100 naked puts of Netflix or whatever, then the market maker eventually will have to short the stock, because then the cumulative delta of that huge amount of thousands of option contracts which expire on that same day, they basically amplify the volatility in the stock price. And by that, it's easy to understand that the market structure, it's altered, it's changed completely. Because we can have Meta, which after hours it moves wildly, it drops $20. because there is whole positioning in the option trades and high frequency firms, that whenever the algorithms rings the bell and my video comes up, the algorithms start to, with this huge, very rapid transaction, they try to find the arbitrage, or they sell rapidly, or they rapidly buy a stock, or I'm probably not explaining very wisely, but because I don't work in a high frequency firm, but the mechanics are this, is trying to exploit an arbitrage, which in stock market there should not be free lunch, there should not be any arbitrage. So we have cracked the efficiency theory hypothesis, that the market are efficient. And by that we are basically, when there are lots of volumes or a lot of transactions which push up the market, I am always very concerned, not because the price goes up or down, but what is the underneath structure in the market, because you can have a lot of delta and gamma and delta hedging, which is daily expiring. So you have a volume created by trading derivatives, or you have a lot of volume of buying by high frequency transactions, which go in and out in a microsecond. The price is inflated. And then there are all sorts of other market participants, which are retail traders, which are people who buy stocks because they want to have a stock portfolio. They can benefit from high prices, but they can from seeing the price growing, but there is no real structural substantial value in that price, because it's all pumped up by the large scale of high frequency transaction and the intraday option market. So that's why it's very, very complicated to navigate market these days, whether it's on an intraday perspective, on an intraday basis, when we are looking at 1 hour chart or 10-minute chart, because the market structure, it's not what it used to be. Technology basically provides such rapidity in transactions that market, I would challenge anybody, even at the SEC or the, I don't know, ECOFIN, or not the ECOFIN, the ECB, whoever comes up. Stock market, they are not efficient anymore, because there are players in the market. Let's set aside the Congress people who have insider trading information, okay, which is scandalous. But there are firms in the market which, by means of speed or sheer speed of transaction and the large investment in technology, because they have a standalone technology in servers and the direct connection to stock exchanges, terminals, and that kind of stuff, which is a very high level. And those firms, they are able to exploit tiny micro changes of disalignment in price on each and every financial security. And that brings whole plethora or hundreds of millions, billions of profits, gross profits, okay? But the substance, the value of that company, it's not reflected anymore in the stock price, because the stock price can be artificially pumped up by a huge volume of buying or selling, which goes in and out in seconds. But then who ends up with the very expensive stock price is those who have the 401k, those who have savings in stocks. And then if and when the market, basically this whole pump and dump scheme collapse, or you take some air out of the bubble, then the sharp move down in stocks, let's take Meta, it's gonna be way worse than brutal, okay? Let's see, we have a gap in price here, which is $100, okay? So what happened in Meta, it's exactly what I'm telling you now. So that the prices of Meta, they are transacted basically on a very fast, high frequency scale. On top of that, or on the side of that, there is the 0-day trading expiry option market, which causes all sorts of hedging dynamic to kick into the market, delta hedging, the gamma. So when you see that those option chains, and you see the delta and the gamma changing so rapidly, okay, and then you have to take exposure in a certain direction, then you see that corner of the market, which trades option daily, intraday, it pulls the weight of also of other more cautious investors, which can be institutional or hedge funds. And then they have to take exposure, they have to take one side of the trade. If you are a market maker, as I said before, and you write call options, you need to buy the stock. So the upside movement, it's amplified because you need to delta hedge your books. The same is on the downside, Okay, so Meta can go to $760 by just only because of the push of the market based only on delta, gamma, and delta hedging and high frequency trading. Let's put it like that, on the volume of transaction. But the substance, the value of Meta is not 760. Suddenly it becomes 650. So if I'm a retail trader that I have Meta in between in this $100, okay, here there are $100, guys, of vacuum. Okay, so this vacuum, okay, this gap in the price, how can I fucking explain it to somebody who bought Meta at $700 and say, okay, now Meta is going to the moon? No, it doesn't happen like that. And then in this huge gap, there are a lot of people who lose money, who probably lose savings, or they see their 401k and they start to be worried. Okay, say, okay, somebody shuffled me Meta at $700 and basically I got a very bad price or bad investment. So this is what I'm saying, that it's actually very real. The structure in the market, it's completely different from 10, 20 years ago. Forget about the 1980s or the era when Warren Buffett was doing portfolio and was building Berkshire Hathaway. Nowadays, the market is all about huge speeds of transactions in nanoseconds, microseconds. And there are these intraday options which cause the whole of all side hustle volatility that we have. Now you see here, Jesus Christ, okay. If we take the chart of Meta, you have a huge gap here, which is $100. It's huge. So the value in that price, there is no value. There is absolutely no substantial value in that stock price. It's all made of financial engineering, leveraging the speed of technology that pumps up the price. And there are arbitrageurs which go in and out, that make the microsecond tiny profit, do it for millions of transactions, you bring home billions of dollars, right? And then there are those who exploit intraday option, but the retail investors is the one who is worse off, because there is a huge gap in the price, and how you're going to recover from that. So that is no more the case low. Yeah, it's low. It's down the low. The $750 or $60, it's gone down the low, because now it's $650, and it will keep going down probably, because then there are all other sorts of dynamics that then the retail investors wakes up and says, okay, I need to start selling Meta because I have some tiny profits, or I don't want to get caught in this avalanche, this havoc. Okay, but this is a huge gap, and it's all created, the market closing and opening after hours, or you can eat whatever you want to say. But this is symptomatic of the market structure that it's completely changing. It's altered its nature, and it's very, very, very dangerous. It's dangerous for retail investors who can see these wild swings in prices. Okay, because here there are $100 missing in the stock price, and those who do high frequency trading, they probably have profited from that, but those who have a 401k, maybe not, or those who basically have invested in Meta at very high prices, they probably lost some money. They are underwater. So I diverged a little bit, but it's very, very important, because the more we move forward with stock market, we see that the market structure, it has changed a lot. So it's probably necessary to have more and more sophisticated technical indicators to try and understand things. And I think that then regulators, the SEC, they should really do something, because there should not be a free lunch every day for speculators in market. But as we can see, there are arbitrageurs that are able to exploit all sorts of price discrepancies between exchanges, or in a time space of a very tiny fraction of time, and they make money. And then the price goes up or down without any substantial value that justifies that price. And then it's just the volume of transaction. And then the day after, you find that the stock price is worth $100 less. Technically, it's called a pump and dump scheme. which are illegal, are technically illegal, but by calling it high frequency trading, we have changed it, we have created the product, the alternative product, to justify certain things, which probably I will not. So what we can expect for the market going forward. Here, for example, we have a nice correlation chart, which tells us, okay, we have, let's take a risk assessment heat map of the valuation. Are we in a bubble? What is the overvaluation score, the bubble score, the composite, the risk score, etc. Of course, the darker red is the color, the more concerning is the flashing red signal. Okay, so this heat map basically captures mostly the overvaluation that it's happening in all equities. So it's NASDAQ, the Dow, the S&P 500, all the different kinds of S&P industrial or services sectors, also for gold and silver and stuff like that. We are abundantly in the overvaluation score. Here, what is 92? Okay, S&P 500 utilities, they have a 92.5 score of overvaluation. So if you are at home and you are complaining that your bills, they are sky high expensive, it's eventually because all utilities companies, they are hiking prices, they are seeking profit, they are trying to exploit the market to achieve some extra profit or abnormal profits before basically the whole economy implodes, because nothing is affordable and you have a cycle of defaults, which already has been happening with First Brands, with Tricolor, and other or the problem with regional banks. So you have an underneath, you have an undercurrent of what happens into the real economy, of people who are struggling with the bills, or now there is a shutdown in the United States, so people, they don't have food stamps, they don't have salaries, there is credit card debt, there is auto loan debt, there are all sorts of things. So you have an economy which is grinding to a halt, and so with the risk of a cyclical default of taking more and more force, like a wave of defaults becoming larger and larger, becoming a tsunami. And on the other side, you have this, for example, the utilities S&P 500 index, which is at an overvaluation score, because of course investors, they're going to exploit where these utilities companies, they are hiking prices, they provide dividends, so it's easy profit or easy dividend to take. But we are in an overvaluation point, so even utilities, they are utility stocks, they are very, very expensive at this point in the cycle of the stock market. The NYSE, New York Stock Exchange Index, 94, huge, is the top overvaluation score. So the index is a lot overvalued. No, sorry, that's because it's in diagonal. So is the NYSE, the American Composite Index, is the most overvalued. But I mean, if we move towards the most known, we see here that the NASDAQ, the Composite Index, it has an 82 points, 82 score valuation or overvaluation, so it's overvalued. The NASDAQ 100 is 74.7, so it's also very much overvalued. And also the Russell 3000, 83.3, it's overvalued. So the broader market, by the measure of Russell 3000, it's becoming overvalued, and it's pulled or driven by the tech sector. And we see also that the utility sector also, it's high, because probably cost of energy, additional cost of energy for all the AI mumbo jumbo and stuff like that. Here we have 91. So the oil, as I said, the Philly Arca oil index, it's very much overvalued. Corn, it's overvalued, and silver, it's 54.8. Gold still, it's okay, 35.2. It's on the greenish shaded 35.2. Is not very much overvalued, but in the shorter term, we have a bearish expansion of gold futures prices. So it's reasonable to expect the baby bear being born being born out of the gold prices. It would be reasonable to expect gold prices to go down to 3,800, 3,600. That's the baby bear that will be born out of this bearish contraction expansion. So on the bubble score, we have the NASDAQ 100, which is 50. It's a 50-50 bubble score. So we are approaching the bubble territory, high score territory, for the tech sector. 62.5 is also a similar index, which is the S&P 500 information and technology sector, 62.5. So the score is even higher than the NASDAQ 100, because some large cap from tech, they've been moved to information technology companies. I don't remember, they move around stocks, they move around things, so that can be also a factor. Also the S&P 500 industrial, it has a score of 50 for average, what is the bubble score, 50% bubble score. And here, silver prices, we are at 50% bubble score, double bubble score. So the heat map it's a fancy, a very concise thing. It tells you basically how high the market it's going and how far we are in the overvaluation or the bubble territory for certain asset classes. And the theme, it's always the same. It's technology who pushes up the market. Now we've seen that utilities, they are very much overvalued, or information technology, or industrials, silver. So there are certain financial assets which selectively can be basically kept on hold, or if you are more prone to do risk management, you can start to decrease exposure to tech sector. You have to stomach and say, okay, I want to ignore the upside, I want to decrease the exposure, because we saw that Meta can lose $100 just in a puff of smoke. You know, the $100 is gone, because that's pure volume, so it's pure pump into the bubble. Okay, so those are technical risk management choices of any financial institution, retail investors. I'm not giving advice to anyone. I have my material, I form my own idea, my own framework of work, my own framework about the stock market, and I don't dare to suggest anything to anyone. The only thing I can do is say, okay, I got this dashboard and says, okay, probably gold is could be going down a little bit because of certain market dynamics, or there is this overvaluation in certain sectors, and other similar things. What is interesting is the CAR, which is the cumulative abnormal return, which are those that basically come after even. There are those that are seeking alpha, they want to generate alpha, positive return for investment, but there are also the cumulative abnormal returns, which are above the alpha. Here we see that the NASDAQ 100, it's on a level of a cumulative abnormal return with the risk score. It's here. It's in this light sand color. So it means that the cumulative abnormal returns that the NASDAQ 100 has been providing for a very long time, they are approaching a risk level which is consistent with the overvaluation score, which is consistent with the bubble 50%, 50-50. We are in a bubblish territory for the NASDAQ 100 and all the stocks, or the 100 stocks that are in the NASDAQ 100. So overall, you can say, okay, I know that all the cumulative abnormal returns that have been provided by this wonderful mega trend of tech stocks, they are approaching a very high threshold of risk. So what do I want to do? I don't know. It's the choice of whoever deals with these things. It's not really my choice. What is a higher risk for the abnormal returns? S&P 500 materials is in that territory, in that level. What we find, which is a very safe, is the Russell 1000. It's very green. So the cumulative abnormal return, they are not very risky. So probably because they are small cap, they are not very much regarded as vis-a-vis the large tech, the large mega Mag 7 or whatever. So small caps, they're not very much searched for investments, but there are pockets of value in small cap stocks. And technically, just for the heat map, they carry less risk, less investment risk compared to investing into Meta at $600 or Netflix or an Amazon or an Apple or an Nvidia or AMD or Oracle. That corner of the market it's pricey and it's very, very risky. So what I can take away is that stocks that are in the Russell 1000, still they can provide cumulative abnormal returns, but the risk that I have is way less than investing into tech stocks. So we can approach and say, okay, we want a rotation. We want, from a cyclical point of view, I want to reallocate my asset. I want to shred some weight, some exposure from large out of tech stocks and go into Russell 1000 stocks or some other parts of the market which are less risky, which can be consumer staples, because the consumer staple index we saw here, let me close 1 second and the consumer staple index, we have a buy signal here. It tells us the cyclicality of the consumer staples index, it's turning up. Okay, so I can basically find profits in buying Russell 1000 or being exposed to consumer staples, not discretionary consumer staples, and I can sell Meta, I can sell Netflix, I can sell Oracle, I can sell AMD, I can sell Nvidia. That makes perfectly sense, because also is a point of what is the business cycle. We are in the season where people, they spend more on food and clothes or staples, and so those companies, they are expected to have more income, generate more revenues compared to tech companies. But we are also in that period of the year after Halloween where basically the market wants to find a trough from where to start again. And we know that the trough in the market, in the cyclicality on the market, happens between Q4, the end of the year, and the Christmas rally, and Q1. So that's the broader flavor, the dynamics of what happens from a cyclicality point of view. But the cyclicality is not an abstract concept. We can find the cyclicality by doing Fourier analysis, by doing Fourier reconstruction of the trend. And we can gather a lot more information, which are very, very interesting. Now, let's see what other things we can have. Here we have another dashboard, which derives from the modeling that I put in motion on Python by trying to navigate the market with cyclical, by basically interjecting the cyclicality in the market into a trading signal, and with other trading indicators, we try to understand at which point we are into the market, if we want to buy, hold, or sell the many different asset classes that I put together. Now we popped up on soybeans, and we see how the market cycle signal, it diverges from the RSI. So the RSI is up. So the soybeans, they are really overbought. Okay, and the market's cyclical signal, it's turning down. So it tells you, okay, the price, it could be entering a bearish phase. So if you are a commodity trader, probably you can start to sell soybean futures, or you can do some hedging. But basically, the technical stuff is that one of seeing a different level of from the price action, which can be a leading indicator of what is the cyclicality of the price action. Here, for example, we have a complete trading table for the next 30 days. So what we do here, these are only for just I'm showing you a sample of how the technical indicators that I built work with the data that you have. So you do some sort of past backtesting of things, and it comes up with a dashboard of trading signal. But I don't use trading signal just to give you a flavor. We interject this data with these models with 5 years of trading signals. Okay, and then there are different strategies which are mean reversion, or can be cyclical breakout of the price, and then it identifies the bullish expansion, the bearish contraction, what is the Sharpe ratio, all the metrics, all the parameters that you want to have when you are testing some trading signal, some trading strategy, and you want to know which approach to the market, based on 5-10 years of data, can be more useful for you to understand what happens and not take wrong decision, basically. So we see here, okay, performance overview.
Average return of the strategy 24.57%, the Sharpe ratio 0.35. The best returns are provided by trading the VIX with this strategy, and the best Sharpe ratio is 1.55. Okay, positive returns are for 28 out of 34 tickers, which are all indices or gold or silver or the volatility index, etc., etc., etc. So then it comes up, it says, okay, it doesn't say anything. You have a dashboard which tells you, okay, for the next trading days, according to the signal that we extrapolate from the model that you're going to interject on the data, you have this with traffic lights, dashboard. So here, in the very short term, we have a sell signal for the NASDAQ 100, the Russell 3000, even consumer staples, which is not the same as consumer distraction. Which is not the same. This one is the S&P 500 25. The other one with the buy signal is the S&P 500 30. Okay, so these are two different indices. The NISI American Composite is the index with the highest bubble score or overvaluation score that we found. Even natural gas or corn or soybeans, at this time of the year, in winter, you want to probably sell those future contracts, or you want to find some crack spreads. Those are very nuanced technical things to do for commodities traders, those who have to hedge the corn or the soybean harvest, and those are very... And the unmissable, the oil services index, it's overbought, you need to sell it. So the S&P 500 materials, it has a buy signal, and yes, the S&P 500 30, as I just said, it has the strongest buy signal, which is consumer staples, and when instead the S&P 525 probably is the consumer discretionary. There is a misspelling in the dashboard, which has a sell signal. So discretionary items, you can sell it. What are staples? You can buy the index because those are the items that are missables. You cannot live without staples. But discretionary items, it's a no-no. We don't have money for that. On gold, it says to hold. If it's gold, you hold, which is it is very it's funny because the trend is your friend, gold to hold, but we need to bear in mind that we have for the same models that I implemented, we have a short-term sell signal for cyclical bearish expansion, which is not it's a sell signal, but it's a cyclical bearish expansion for gold. So you can hold, but it's there can be a drawdown in gold of 8 to 10%. It's very much possible. Okay, and the drawdown, it's soybeans hedging. So we're selling the futures, and then we're going to buy back, I don't know, at some point next year. I'm not familiar with the commodities side of hedging the harvest of agricultural commodities. So all in all, here this model tells me in the short term I have a short signal for the NASDAQ 100, the Russell 3000, the NASDAQ, the Composite, and the NISI American Composite, and even corn and soybeans, and the oil services. Okay, and then what you could even here, the Russell 1000, the S&P 500, it has a amber or yellow, which is reduce the exposure to those parts of the market, and we have here, okay, cycle weakening, take profit. And then here, the NASDAQ 100, even though you have a huge uptrend, it already tells you the cycle is turning. So it's very forward looking. The cycle is turning strongly downwards, so you would sell. So it's funny to see the output of the machine of the modeling, because then you always need human being judgment in assessing what is the cyclicality or the models that you build around the financial assets of the market. They are very useful because they give you, it's like road signs, and it navigates you. It's like a compass. It navigates you these waves, cyclical waves of the market. So what I will do basically for Q4, I would ignore Santa Claus rally. I would definitely go for staples. The S&P 500 30, which is the ticker in Yahoo Finance, which is this one, okay. I would definitely go long here, consumer staples. And I would wait out for NASDAQ 100, NASDAQ Composite, Russell 3000, NISI, and even the S&P 500. The Dow, I would wait out for that. And I don't know, I would wait and see what happens with gold, because gold prices, gold futures, are they've been hugely volatile. Now, the model gives me also, let's see what else we can, it gives you also advice. So immediate action, sell now, overbought condition, oil services and soybeans. High priority trades, buy consumer staples, and short NASDAQ, Russell 3000, short the other consumer discretionary, the NASDAQ composite, the NYSE American composite. Sell short, and it gives you also target price, which is very, very useful if you are an institutional investor, if you are a trader or stuff like that. It gives you a trading idea, and that you can basically benchmark with what happens into the market. And so by testing this thing, by having the market benchmark to see what really happens in the following period, then you can gather more or less confidence in the model that you have. So that's what do I do basically in my spare time, together with studying BSc in finance. I do all these sorts of tricky things. And okay, so the Excel file that come, the Excel sheets that come from all those modeling that we have this very nice table, and it basically tells us what is the phase of the market. So the S&P 500 is bullish expansion, you want to hold, or you want to reduce. Russell 2000 bullish contraction, so you want to reduce. Russell 2000 value bullish contraction, you want to reduce exposure. S&P 500 financial, you want to buy. I could basically decide. I didn't do anything. I just load the thing and see what are the results. And yeah, okay, gold. You are in a bullish contraction, or that can become a bearish expansion, so you want to reduce. You want to short gold. Silver, bearish contraction, hold. I would not be so sure of that. Even natural gas. This is very, very fun. Very, very, very fun. Okay, so I think we are done for today. I am done for today. Thank you for following the channel. If you have subscribed, you are very welcome to leave a comment. Just drop a like. Follow this channel because I have a lot of interesting content, and I can spoil the Christmas party because I am just trying to find where is gonna be the next big market drawdown. But I want to just love you and leave you with this a small, not with a small. I want to love you and leave you with the last bit of data that I can give you, which is quite substantial, and it's basically how do we utilize a Fourier transform and take the parameters. Okay, so I have my Excel here. Here I have a summary table of what are the dominant periods. Then I can if I take page by page, then you will see something very interesting, which is which are the parameters that come out from the Fourier transform. So we have the AK and the BK, which are the parameters of the Fourier transform, and then we have the amplitude and the phase, what is the cumulative variance explained. Okay, so we have the most dominant period, it's 9,025 days, that's for the S&P 500. So you have the AK, it's 2, the BK is minus 2.77. Those are calculus, Fourier calculus numbers, and I would not utilize it here because still I will have to learn how to solve an equation of that sort, but I'm getting near to solving it. Then we have the parameters, which are the amplitude of the period that we have. So the the amplitude of the period or the function that we reconstruct. And what is the variance? From that we can understand how much volatility is explained by the longer period, 9,000 days, it's 30 plus years. And we see that the cumulative variance is 0.31. If we take a period of 1,800 days, 1,800 days, let's divide it by 252, so it's 7 years, we see that the cumulative variance explained it's 0.91. So more volatility, of course, is explained by shorter and shorter cyclicality, periods of cyclicality in markets. Okay, so the volatility, it's that parameter in market which jumps up suddenly. It has a huge spike in volatility. You have a clustering, spike in volatility goes up, 20, 30, VIX goes to 20, 30, 40 for 1 day, 2 day, like a week. If it's a week, then all alarm bells start to ring everywhere. But it's a very short period of time. Okay, 1 week, it's nothing compared to 9,000 days. Okay, 7 days or 5 days. So let's make the measure, the proportional measure between the period that we have and the higher explained variance that we can gather from these parameters. Okay, so when doing this kind of study of financial asset prices, which transforms the whole thing in a whole other beautiful calculus, beautiful. This is a painting. This is, for me, it's like a Picasso. It's not a Picasso. It's a Monet or something which is beautiful. Okay, so okay, harmonic 5. We see here the harmonic 5. It's the blue, and that's the frequency that we have, and the amplitude, which is 1,800 days, which is 7 years, and we see how the cyclicality works, and the years, they are on the x-axis. Okay, so we start from 1990, it's 35 years, so every 7 years you have a certain cyclicality that works through the S&P 500 price action. Okay, and that's basically is the cyclicality of investing into an index, the cumulative abnormal returns that you can get by going long into an index and forgetting about it or something like that. But that cyclicality, it has a certain time frame period. I know I'm repeating again, but these numbers, they are exactly in that chart. You see the different bars in the amplitude spectrum, they are here. Okay, so the amplitude 3.44, it corresponds exactly to the pink longest 9,000 day periods, and then you have shorter and shorter bars, and you have the phase angle. So by measuring the phase angle, then you know at which point of the cyclicality, the rotation of the cyclicality you are. If you are at the beginning or if you are approaching the end of the period. And for that, you know if the cyclicality in the market is actually changing. By the phase angle, you know if you are approaching the end of the bullish expansion, so you are in a bullish contraction, then becomes a bearish expansion, then a bearish contraction. So all these different names and tags that you can stick on that, labels, they all come out from very precise parameters, right? Yeah, we have the table with all these things, and so we can use the amplitude, the phase, and all the data that we have, and we inject it into another model, and we want to know, and so we utilize those parameters, and we want to try to generate a forecast of the cyclicality period, the following period. So what do I have here? It reflects more or less the seasonality of what actually happens in very simple terms. Is that basically we have a trough in January 2026. So it forecasts the turning points between 2025 and 2030. But by no means it can be precise, because we cannot have a very long, even a medium time horizon for what happens in the market as a certainty. It's unbelievable. But we can see how through these parameters we have some sort of reasonable data that come out. Of course, I can improve everything, but it's reasonable to expect that we have a trough in January or another peak in March. So we have a downward market correction between January and February, and then the market picks up between March and April, and then we can try to match up. We want to match up the data that we get from these, that I get from these models that I implement, and what really happens in the market, so that I can see how good or bad I'm doing with these things. So, but nevertheless, it's useful, it's insightful, because it gives you lots of parameters and explains you very clearly, okay, the peak, it's March 2026, then you have some value of parameters, which I will have to identify better what to what these correspond to, and okay, times ahead, for months ahead, and stuff like that. So I tried to pull together more data and to extrapolate the forecast with the cyclicality method. Let's put it like that. And we see here how the cyclicality happens between in Q1, January and February, from December, January and February, you have a pullback in the market, you have a trough, then you pick up again, then you can have a trough in July 2026, you can have a peak in December 2026, which make totally sense, and you have a trough in March 2027, so it goes very far forward, not very far, like, it goes forward enough, but what I can appreciate, it actually reflects what is the most known cyclicality in investments in markets. Because for me, for example, it's reasonable, we have a high in December 2026, and basically the market will have a trough in the Q1 2027, because those are what usually happens eventually. And then you have another peak between the summer season, and then you have another trough. So that's basically how it works. Now, the months of the year, they may vary, because the cyclicality can expand or contract the period. The amplitude of the period can be wider or narrower, but those are the dynamic or the mechanics of this kind of reconstruction of market trends, which are very fascinating. So let's compare. If here I have, okay, here for example we see that that's the composite, that's the NASDAQ composite. It tells me immediately that we are going to have a trough that will be in March 2026. Here, you can see here. And we are going to peak again the upcycle in May 2026. So it's reasonable, some sort of reasonable, or we want to match our model expectation to what are the outcomes in the market. And so my model tells me, okay, according to all the data that you got, the parameters you gave me, and the cyclicality of the NASDAQ composite, you can expect a trough or a bottom in the market in March 2026. So if you are patient, if you want to wait it out, you wait it out up to March 2026, and you want to see if all this volatility happens. And if it happens, then you can enter the market, and you know that your investment will peak in a very short period of time, in 60 days, between March, April and May, in the span of 60, 70 days. Okay, so I will go in at the end of March, I will stay in April or May, and then I would assess if I have to get out again. So these are very nuanced method of doing, per se, asset allocation according to the cyclicality, being sure that the forecast is actually precise. So of course you need to produce a model to match it with the real data, and then you know that if your experiment succeed, then you can use that model to actually in a real environment and try to do asset allocation according to a certain method of extrapolating market cyclicality. So all in all, whenever the data we put it through and we try to do very complicated things, we come up with reasonable results. Also, the NASDAQ 100, same cyclicality, we expect a trough in March 2026. So it's reasonable to expect in the next couple of months, to have a market drawdown, which is perfectly cyclical with what happens between Q4 and Q1. For what concerns Movember, we have all the dashboards that tells us that all these parts of the market, which is tech, S&P 500, information technology, and gold, they are very, very risky, they are very volatile. And so reducing exposure to that part of the market and then probably going for something more safer, more dull, which is consumer staple, then it's the safest bet to have, okay? Which to me makes totally, it makes sense, basically. So that's what I would expect. So let's see if we can find the gold somewhere, because it's pointless to... Now the VIX, okay, it's peaking in October 2025, which has not peaked. It's gonna have a trophy mark. I don't know. Of course, we will have to check, double check, triple check all this stuff if it really happens. Okay, but what we can gather here is that there would be a period of high volatility. No, I think that this series starts from before. That's why it gives me a forecast in October. So let's take this one, which is up to the latest date. Okay, let's go for gold. Okay, so, okay. It tells me, for example, here that oil futures will have a trough in July 2026. So probably oil prices, they will have a bearish market, not bear market, but they will continue to go down, some sort of decrease in price up to July. So you could expect some sort of a few months of expansion of this downward trend in oil prices. And we'll see what will happen. It's interesting. So silver is going to trough find a bottom in January 25, up in March 2026, but then it's a sort of bear rally because it's another trough in July 2026. So we can see here how the market will behave in a sequence. Finally, we get to gold futures, which is the same. So if gold price volatility, it stands according to the model output that I got, the bottom of the volatility, the trough of the bearish expansion or bullish contraction in the gold prices will happen in January. And then you can enter January and exit April, or yes, because then there is another trough in July, and that's almost, and then go in July, and then if you want to go long, of course, and then you have another peak in September next year, and the bottom in December next year. This is very, very interesting what these parameters are telling me. Now I want to see the counterfactual of the volatility. Dow Jones Utilities. Okay, I just want to see the volatility. Okay. Yes, that makes more sense. Okay, so if we start the forecast here by the 1st of November, the VIX would peak in December 2025 and be in a period of some sort of higher volatility up to May 2026. So the volatility index, my cyclical forecast model, tells me, okay, we are going to have volatility going up in the coming months, and this volatility will stay into the market up to May, down to May 2026, when we will have a trough. So it will be gradually decreasing. That's the same for the VXN, which is another measure of VIX. It works exactly the same way. We have a peak in December that will last down to September, even longer time horizon for this volatility benchmark. Here we have a trough here in November. Okay, and a peak in April. This VXD, it's probably associated with some index. Let me double check for you 1 second. I don't know every ticker of the... Okay, so the VXD is the volatility index for the Dow, and the VXN is the volatility index for the NASDAQ. So we have the volatility index peaking at the top of the cycle December 2025. So we should have some volatility in the coming weeks and months. But the bottom of the VIX cycle, it would be in May 2026. So I presume that this volatility will stay for all Q1, of course, and a bit more also April. And May will be probably the months to go in. I don't know. That's strange because usually it's sunny May and go away. Then the VXN, which is the volatility index for the NASDAQ, will have a cycle peak, cycle position, higher value, so higher volatility in December, but it will last to September. So I don't know if 2026 is going to be a volatile year for the NASDAQ, and the same here. Not the same. This is a bit different. It tells us that the volatility in the Dow, it will reach its bottom, its lowest value in November, and then it will start to go up, and it will be into the market up to April 2026. So we see how this is accounting also for the past short-term volatility, and it tells us, okay, the cyclicality of this period, it will bottom in these weeks, and then it will start to pick up, and it will go on up to April 2026, which is very, very reasonable. That's for the Dow Jones.
So, having said that, I'll thank you all, and thanks a lot again. I will see you in the next video. Okay, I can show you just the volatility. I'm thanking you. Thank you again. I'm finishing the video. I'm not finishing the video. Okay, I forgot that I have the volatility structure also. I have so many things that I'm better than Goldman Sachs, Morgan Stanley, and JP Morgan altogether. Here we have. I can show you the volatility curve. You can see how in the next months the VIX curve is in a contango, so it's expected already. The VIX futures market is expecting higher volatility in the coming months, which is reasonable, matches reasonably with the forecast that we have of volatility reaching its lowest point now in November, let's say. Although we should start to see some volatility in November going into December, and probably we will have higher volatility in whole Q1 up to April or May 2026, and that's very important for those who use volatility spreads, who hedge their books with volatility spreads like such as Goldman Sachs or stuff like that, because basically what happens is that you see here, it's very, very interesting. So here VIX, the term structure up to 30th of October, the highest value that we expect in a 6-month time is 22. The VIX curve is in a contango, so the market is pricing in already higher volatility. But what happens is that those institutional investors or hedge funds, but mostly investment banks, who hedge their books by using VIX, by using volatility futures on stocks or indices, what happens is that the rollover of their futures on the volatility index, it can be the VIX or the volatility on the NASDAQ or the Dow, etc. The yield, as long as the volatility creeps higher, the rolling of these futures, it becomes negative. So that forces the investment bank to buy more volatility to hedge the negative rolling that they have, and so that makes an amplifying, expanding volatility factor in the market. Only because of this hedging that they have in investment banks, because they hedge with futures, VIX futures, and when the rolling yield, you see, goes down, you see these peaks that point down, it means that the rolling yield of the VIX futures, they become negative. At that point, you have a spike in volatility market, because to hedge this negative rolling yield, investment banks, they are forced to buy more vol. They cannot short vol anymore, or even to hedge their books with stocks and stuff like that. Basically, they use VIX futures and other very complicated financial engineering. But then what happens is that all this compression of volatility or this hedging of volatility makes the rolling of the futures contract negative, and then produces also a volatility increasing into the market. But what we know, last but not least, is that the VIX term structure is in a contango, so the market, the investors, they are pricing higher volatility in the coming months. Okay, and so thanks a lot, and subscribe. I will see you in the next content I will provide with more of this data. I will have more on the European market, what is the cyclicality of the European market, whether we are expecting some more volatility in this Q4 and Q1, and what retail investors should eventually do to protect their savings or protect their investments. If you don't need saving, yeah, I don't need saving, that's pretty reasonable, and you want to play fast and loose, with checking what is the cyclicality in market, you can see whether to reduce your investments in technology and probably invest more in consumer staples or in gold or silver or these other kind of stuff, or materials, or then thank you so much, and see you soon.